Hi guys, welcome to another Trendline trading video. I am super excited about today. So I'm gonna be breaking down an entire A to Z masterclass of how to trade trend lines. But before we get into the charts, I want to introduce myself and set the tone for this masterclass. My name is Tori and I have been trading trend lines for 10 years now. I learned a trading strategy from a family member and I have been able to generate $500,000 in trading profits. One thing that kind of sets me apart from the rest of the industry is I showcase every single trade that I place. I post broker statements, I do entire trade breakdowns, just so that you know everything I'm doing is transparent and authentic. I have a community of traders that I've taught this strategy to who have been able to gain success in the markets. I have thousands of community members. My approach to the markets are also fairly unconventional because it is incredibly simple. I'm not interested in complicating the process, trying to utilize indicators or pull information from places that I do not need. I need the bare bones to get me into a trade and out of a trade. So what I focus on is a simple approach, clean charts, clear structure, and that's where I've seen the most success. Trendline trading is one of the styles that, if you can use it properly, can give you a serious edge in the markets. It's simple and effective and easy to replicate time and time again. This masterclass is not just a quick how-to, this is a full breakdown from A to Z. If you're a beginner, you'll be able to pick up trading after this video. Or if you're already experienced, you'll be able to sharpen your edge. I have designed this to be something that you can actually follow, learn, and apply. Also in this video, I'm going to walk you through my exact strategies that I use every day in the live markets. Before we get into this, I want to set the realistic expectations that you need to have. One of the biggest reasons that traders struggle is because they have this unrealistic expectation that they're going to get rich overnight. They're going to make thousands after watching one singular video, and that's just simply not the case. In reality, trading is a skill that takes time to master. You have to treat it just like a profession. It takes patience, commitment, consistency, even when you don't see the results right away. I have been able to generate consistency in $500,000 in trading profits, but I didn't think it was going to happen overnight. I gave myself time. I treated this just like a career. I put the years in to perfect it. I followed a process and I simplified things, but I allowed myself grace when I didn't see instant results. So no, this is not easy money, but it is possible if done correctly. If you're willing to commit to the process, stay disciplined, and learn a strategy that is built for longevity, you are in the right place. This strategy that I'm going to walk you through in this masterclass is the exact strategy that I use in the live markets. It's structured, it's simple, and it works if you do. Let's get into it. First, let's go over the basics of trading and how you can make money in the markets. But if you're more experienced or already know this, we have timestamps in the description below to where you can skip to the section that's more relevant to you. Trading at its core is the process of buying and selling assets. It's a simple idea, but it requires skill and strategy to do it consistently. Okay, I'm going to give you some analogies to help you understand it better. Think of trading like buying something at a discount and then later selling it for a higher price. The classic buy low, sell high concept. For example, imagine that you buy a vintage comic book for $10 because you believe the value of it's going to go up. If you sell it later for $15, you've made a $5 profit. That is essentially trading, doing that over and over and over again. Trading works with the same principle, but it's with assets like stocks, futures, forex, and crypto. So the key here is understanding the optimum time to buy and the optimum time to sell. And that's when analysis and strategy comes into play. Now, one important thing to remember here is you can make money when the markets go up or go down. Most people think that you can only profit when the price is rising, but that's not true. In trading, you can also profit from falling markets. Think of it like selling high, buying low. This is called short selling. So this is essentially you selling an asset before you own it and then buying it back. But we'll go over more of this concept later in the video. So whether the price is going up or down, there is always an opportunity to make profits from the market. As long as you know what you're doing, that's the real benefit of trading. So in this masterclass, you'll learn how to spot these opportunities so that you can enter and exit trades with confidence no matter which way the market is moving. Before we get into trend lines, it is important to understand the super basics, candlesticks. If you can appreciate a little bit of history and you're fairly a nerd when it comes to trading, you'll appreciate the history of the candlestick. Candlesticks were originally developed in Japan by rice traders to track price movement. But today we use the same method to track different assets because it's so effective. All right, let's get into candlesticks. So what I'm going to do is draw two candlesticks here to show you the basics of each one. So here is called the body of a candle. The difference between the green candle and the red candle is this right here is where the price opens. So at the beginning of the day, the price started right here. This is a green candle and represents price pushing up higher throughout the day. And then at the end of the day, we've got the close, which is going to be right here. This is the closing price. So we've got the open price and the closing price. What makes this one green is that the open price was lower, then pushed higher throughout the day and ended here, higher. So this is a green candle representing the price pushed higher. Now this right here Same concept. This is a body. But the difference between the green and the red is that price started here. This is the open. And now price pushed lower and closed down here. So the difference between the green and the red, price opened lower, pushed higher. Here, price opened higher, pushed lower. Now this is all within a day. This is a day's worth of price movement. Now let's go over the wicks. These right here are called wicks. Now what these mean is that price pushed lower and higher outside of the opening and closing price. So that means when price opened and closed, it pushed higher and lower outside of the body before closing. So during this 1 day period, price opened here, pushed lower and higher, and then closed. So this is the movement outside of the open and close. Now the same applies for the red candle. This is also the wick, and this is the wick. Represents the same thing, the movement of price throughout the day. So now you know what a candlestick is and what they represent when you see them on a chart. Now let's talk about the different markets that you can trade. Each one has pros and cons, and what market you trade usually comes down to personal preference. So let's break down each one. First, we're going to go over the Forex market. Forex is short for foreign exchange, and it is essentially trading currencies against each other. And what you're doing is just anticipating the change of the exchange rate. So essentially, if you were anticipating that the price of the euro is going to go up, you will buy. And if you're anticipating that the value of the US dollar would go down, you would sell. And there are many different combinations and currencies that you can trade. And some of the most popular are going to be USD and the euro. Is going to be GBP versus JPY. So the GBP is going to be the Great British Pound, and the JPY is going to be the Japanese yen. So there are a lot of different currencies and variations that you can trade. And you can also trade these currencies 24 hours out of the day, 5 days a week. Monday through Friday. The next one we're going to go over is crypto. Now this one I have the least experience in, but I'm sure many of you guys have heard about it. Some of those popular assets that you've probably heard of is going to be Bitcoin or Ethereum. Now this is going to be the same concept. You can either buy or sell these anticipating that the price of Bitcoin is going to go up, which I'm sure many of y'all are thinking, or maybe the price of Ethereum is going to go down. Now, the difference between Forex and crypto is crypto can be traded 24 hours out of the day, 7 days a week. So there is no limit to when you can trade Bitcoin, which means you can also trade crypto Saturdays and Sundays on the weekends if you really wanted to. Now, crypto is known for being super volatile. That means that there is opportunity, but also a lot of risk if you don't have a solid plan. Now, the next one that we're going to go over, which many of you guys know, the stock market. This is stuff like Amazon, Apple, Netflix, Tesla, Home Depot, all of the above, Nvidia, GameStop. Now with stocks, same kind of scenario here. You could anticipate that the price of Apple is going to go up or the price of Tesla is going to go down. So you would either buy thinking the price is going to go up or sell thinking the price is going to go down. Same scenarios over here. Now the stock market is open Monday through Friday from 9:30 a.m. Eastern to 4 p.m. Eastern. Now, there is one more market to go over, and this is my favorite and my most traded market. Now, this is the futures market. Now, this is what I personally trade. Now, the different types of futures that you can trade is going to be things like commodities, agriculture, energies, indices, and that is things like gold, which I know you guys have heard of. That'll be types of metals. You can trade oil, which are types of energies. You can trade the S&P 500, which is an index. So many different types of things you can trade in the futures market. And things like corn, which would be agricultural. So a lot of options here with futures. Now, same concept here with futures. If you were anticipating that the value of gold is going to go up, you would buy gold. If you're anticipating that the price of oil is going to fall, you would sell oil. If you're anticipating that the price of corn is going to go up, you would buy corn. If you're anticipating that the price of the index or index SPY, S&P 500, or the NASDAQ, the Dow, is going to go up, you would buy. Now, how often can you trade these instruments? So, futures can be traded 6 days out of the week, 23 hours a day, with the exception of the market being closed on Saturday. Now, the reason why I love futures so much is it's got ideal trading hours. I love the different instruments that you can trade, but also they move fast. They have a high volume and they offer great leverage. And basically what that means is just your dollar goes a long way. Now, no matter what market you decide to choose, my strategy is applicable to all of them because it's purely based on price action and market structure. And that's valid no matter what asset or market you decide to trade. Now, how do we actually look at markets and analyze the price to find opportunities? Most traders use a platform called TradingView, which is what we're going to go over. And remember, guys, if this is stuff that you already know, feel free to go to the description of this video. We have timestamps in the description, so you can skip forward to a section that's relevant to you. So now let's get into TradingView. This is going to be my bread and butter. This is where every trader lives. This is our home base. So now this is where we can view the movement or the price of an instrument in any market. So right now you can tell we're looking at Tesla. This is the price movement of Tesla. You look to the left on TradingView and these are going to be your tools. These help you analyze the price and mark up your charts. Over here to the left will be your watch list. This is where you can put all of your favorite instruments, all of your favorite assets like Tesla, Apple, gold, silver. This is where your favorite instruments will live. And then up top here, you'll see these are time frames. Before we go any deeper, I want to touch on something that you'll see a lot inside of TradingView, and that's going to be the time frames. Now remember, we went over candlesticks here. Every candlestick that you see on your chart is based on a certain time frame. So if you were seeing the 1 hour chart, each candle represents 1 hour of price movement. And then if you go to the daily time frame here, like we went over in our earlier example, each candle represents one entire day or 24 hours of price movement. Remember, these are the bodies, these are the wicks. This is all of the price movement within a day. So now the smaller time frame that you go in, the more noise in short-term price movement that you can see. The higher the time frame that you go in, you get more of a bigger picture. The key is to understanding each time frame and how it affects the data that you're looking at, and using it to build a strategy that fits you. Some traders like to trade on lower time frames like the 5 minute, the 1 hour, while other traders like to trade on the higher time frames. I personally like to trade on the 4 hour time frame and the daily time frame. This is all going to be personal preference and whatever is applicable to your strategy. So this is TradingView. There are many other features within it, but these are the main 3 that we need to use. Now I'm going to show you how to use TradingView to actually analyze what direction the market is going in. Now, before I show you this information on TradingView, I'm going to draw it out for you. So when you think of the different directions that the market goes in, you think it's either up or down. There is actually a third direction that the market can go in, and that is sideways. So let's go over what these look like. So the first one that everyone knows is uptrend, or some people call this bullish, and it essentially just means up. So if you look at an instrument or an asset from left to right, and the price has started lower and ended up higher over time, we've got an upward trend. This is a bullish trend here. Now within this uptrend, you can see there are areas or times where the price did go down, but we're looking at this overall. Overall, from left to right, the price has gone up. So this is an upward trend. Let's go over the next popular direction that most of you guys know, which is a downtrend. Now another name for this is bearish, and essentially just means we're moving down. Now what this looks like is the price would start higher and over time ends lower. So the overall direction, looking from left to right, if the price has started higher and ended lower, we're looking at a down trend here. Now same scenario, you can see there were moments of up, but overall, over a period of time, we're down. The price is down, price is bearish. Now let's go over the third direction, which is called consolidation. This is a direction that not many new traders understand. This can also be called a range, and essentially just means sideways movement here. So when we're looking at price from left to right, and we haven't made any progress or any direction, we are in consolidation. There are many moments where the price has gone down, the price has gone up, the price has gone down, but overall, we have made no progress. It's still at the same point here. This is consolidation. Now let me show you some real examples on the chart so you can see what these actually look like. So we're using TradingView here to identify the overall trend of an instrument. This right here is the Dow Jones. We're looking at a monthly time frame. And now if we're looking at this from left to right, the overall direction or overall trend of this instrument is up or bullish. Now we're moving to another instrument. Looking at this from left to right, the price is overall down or bearish. This is crude oil. We're on the monthly time frame, and from left to right you can see the overall trend of this is going down. Now this is the third instrument here. This is platinum. This is the same time frame, the monthly time frame. But now if we look at the price from left to right, starting here to here, The price is overall in the same area. We're moving sideways. This is considered consolidation or a range. In these next few sections, you're going to start learning how to actually trade. And I'm going to show you something that I did to help make this a lot easier. All right, let's get into the first real building blocks of this masterclass, a trend line. A trend line is a diagonal line that you draw to connect points of a trend. It helps you define the structure and direction of a market. If that sounds confusing, don't worry, we're going to go over an example here on the whiteboard. So as you guys saw in the previous examples, we were able to identify upward trends and downward trends within the market. Now the trend line is what connects these points in each trend. Since this is an overall upward trend, we're going to draw a trend line to help connect these points to help us identify the upward trend. We're able to connect points within this upward trend to help us identify the direction that it's going or the structure of this trend. So this right here is an upward trend line or a bullish trend line. Now let's go over a downward trend line. Dude, wait till you guys see how we start utilizing it. It's going to blow your mind. So now we've gone over what a downward trend looks like and how to identify it. But now let's see how we can draw a trend line to help us identify a downward trend. So looking at this from left to right, we want to connect as many points as we can with our line to help us identify this downward trend. You can see we've captured all of these points here within this downward trend. Now, when we draw these lines, they aren't just random. So when you start to see price respect this same diagonal line that we just drew over and over again, that is your structure. Now that I've shown you on the whiteboard how to draw a trend line, let's see what they look like with real-time market data on TradingView. All right, now let's replicate the same thing that we did on the whiteboard on the markets here. Okay, here we are looking at the Dow. We're still in that monthly time frame, and this is an upward trend. Looking at it from left to right, the overall trend is upward. If we're going to draw a line on the chart, a trend line, we're going to go over to our toolbox here on the left. Now, you would think we would use the trend line tool. It's ironic that we're not. But we're actually going to use the ray tool to help draw our trend lines. The very first point of our trend line is going to start here with the lowest point that we see on the screen. The second point of our trend line is going to be the next lowest point we see on our screen. We have just drawn our first upward trend line. This has just helped us identify the direction of this instrument. Now let's go over some downward trend lines. Now we have moved to crude oil on the monthly time frame. We're going to go back to this toolbox over here to the left. It's going to be the opposite concept for our downward lines. Our first point is going to be the highest point you see on the screen. Our next point is going to be the next lowest point you see on the screen. I'm going to change the color of this to red so that we can identify this is a downward trend line. So we have just drawn our second trend line. This helps us identify the downward direction of this asset. As you can see, the price has touched here, 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 and here. Now, the more time that you spend analyzing these charts and drawing these lines, the easier it will become to spot these trend lines. Now let's talk about another concept in the markets, support and resistance. So before we get into it on TradingView, let me draw it out on the whiteboard here. Okay, now let's go over support and resistance, SNR. Now I'm going to draw some price action here and show you what support and resistance is. So now remember we talked about the direction called consolidation. This is where support and resistance really comes into play here. So we've gone over upward trends, downward trends, upward trend lines, and downward trend lines. How do we mark up the consolidation that we went over? This is where support and resistance comes into play, S and R. So now when drawing our support and resistance, we're going to do something very similar like we did with our trend lines. We're trying to capture as many points as we can with the price movement. We're going to start with support. Think of support like a floor. When the price got to the floor, it turned around. When the price got to the floor, it turned around. We're trying to capture as many points from the floor as possible. This is called support. Now, resistance is going to be the opposite. Think of resistance as though it's a ceiling. We're trying to capture as many touch points as possible here. Price got to the ceiling and then turned around. Price got to the ceiling and then turned around. This is called resistance. Support, the floor, resistance, the ceiling. Price moves in between. Now we're just simply trying to capture as many touch points as possible. There will be moments where price breaks out of it, but as long as we can capture as many touch points, we have drawn a correct resistance and support. Okay, now let's go over some real-world examples on TradingView. So we've got platinum on the monthly time frame. And now we're going to go over to the toolbox here. And instead of the ray tool that we're used to, we're going to use the horizontal line. Now let's start by drawing our support, which means it acts as a floor. So we're trying to capture as many touch points as we can where the price hit and then turned around. Right here you can see there were many times where the price of platinum hit this horizontal line, which is our support, and then turned around. Hit, turned around. Hit, turned around. Same here, here, and here. Now let's draw our resistance. We're going to use the same tool, the horizontal line, but now we're going to draw this as though it is the ceiling. We're trying to capture as many touch points as possible where the price of platinum hit and turned around. It hit here, turned around. Hit here, turned around. This is support and resistance. Using this tool helps us identify consolidation within the markets. Now this is a time to get excited. This is where it gets powerful. Trend lines and support and resistance work even better when they're aligned. Later in this masterclass, I'm going to show you how to utilize these tools together to help you identify where the price is likely to go. Now that we understand how the market moves and where price reacts, let's go over how to enter and exit trades. This means understanding different order types. There are two main order types that you can use. There is a market order and a limit order. So we're going to go back to the whiteboard so I can show you guys some examples. Okay, first let's go over market orders. A market order. So we're going to say we're looking at the price. If we're looking at the price from left to right, this is always going to be where the price is at right now. If we want to place a market order, that means get me into the market where the price is at right now. So if you place a market order and the price of whatever instrument you're trading is at $100, when you place that order, it gets you in at $100. So a market order is going to be the most simple order to understand. It means get me in immediately at the current market price. Now let's talk about limit orders. We're going to go over the same kind of price action. Now when you place a limit order, instead of getting you in where the price is at right now, you're actually going to tell the market at what price you want to get in. So if the price is currently trading at $100, but you want to get in at $50, you place a limit order. So if the price is currently trading at $100, when and if the price gets down to $50 is when your order will be placed. Your limit order will be triggered. And then the same concept goes for if you would like to place your trade at $150 limit. So when and if the price gets to $150, that's when your limit order will be triggered. So those are the basics. Market orders are for immediate entries and exits, and limit orders are for planned entries and exits. Understanding this gives you control over how to get into the market and how to manage your trades. Now, what I'm about to show you next is how you can maximize your profits and protect your capital. Now that you know what types of trades you can enter, it's just as important to know how to exit those trades. This is where take profit and stop loss comes into play. So I'm going to use the whiteboard again to help me explain. Let's go over a take profit. I'm going to draw price action to help us understand take profit. Let's say that the price is at $100. We want to place a market order, just like we had went over previously, to buy. We are anticipating that the price is going to go higher. So if we got in at market order, that means get us in right now at $100. We want to see the price go up. So we're going to place a take profit order. So if the price gets to $150, I want to take my profit and close my trade. And that would look something like this. When or if the price gets to $150, you get to take your profits and your trade is closed automatically when the price gets to $150. So the actual definition of a take profit is a preset level where you want to close your trade and lock in gains. Now let's go over a stop loss. Now both of these are fairly self-explanatory. The take profit allows you to take your profit. A stop loss will stop your loss. Now we're going to use the same kind of market structure to go over what a stop loss means. So same scenario as the last one. You placed a market order buy at $100, get me in right now, and you're hoping that the price goes up, or you're anticipating that the price is going to go up. What happens if it doesn't, and you have to take a loss? This is where the stop loss comes into play here. So believe it or not, most traders aren't always right. So there's going to be instances where you get into a position and the trade doesn't work out. So how can we stop our losses from being too high or manage our risk? Let's say that we're willing to lose $50 if the price doesn't work out. That means if the price comes down to $50, go ahead and stop my loss from getting any bigger, essentially. So you just place a stop loss order at $50. So for example, it would look something like this. If the price ended up coming down against you, it stopped your loss from getting any bigger, and once it hit the $50, you took your loss here. So if the price came down against you and hit this $50, this is where your trade gets automatically closed, just like the take profit. Now let's bring it all together. Let's say you get into a position and you're ready for a loss or a profit. How do we place both of these orders? Now let's see how we can place a take profit and a stop loss on the charts here in TradingView. Okay, we are looking at the stock Apple here. We're in the monthly time frame. The price is trading at $106 right now. Let's say the same scenario. We're going to place our market order to buy right here. Now, if you hover your mouse over where the price is at, you can see a take profit and a stop loss, TPSL. To set your stop loss, you'll drag the stop loss down to $50. Let's say you're willing to lose $50 if the trade doesn't work out in your favor. And let's say you want to make $50 if the price goes up. So you're going to drag your take profit to $50. If the price gets to $157, you'll take your $50 profit. If the price goes against you, down to $55, you will take your $50 loss and stop your loss from getting any bigger. Take profit, stop loss. Now let's see how this trade plays out. Now here we go. We're up $48.04. The price just made it to our take profit and automatically closed us out of our trade. We were able to capitalize on $50.89 here. So this is a scenario that worked in our favor. We got into our position, placed our market buy order, the price worked in our favor, continued to move up, and closed us out automatically at $50. Let's go over a scenario where it didn't work out. Now we're looking at Home Depot in the monthly time frame. The current price is at $207. Same scenario, let's place a buy market order, get me in right now where the price is trading at now. Now we're going to drag our stop loss to $50, and we're going to drag our take profit to $50. Let's see how this trade plays out. There we go. Our trade has just been closed. And this is a scenario where we had to take our loss because the price moved against us. And the first scenario is where we made a profit of $50 because the price moved in our favor. So as you can see, both take profit and stop losses are essential to risk management. They help you control your risk and keep your trading consistent. Later in this masterclass, I'll show you where I put my stop losses and my targets based on market structure and price action. Okay, now let's talk about risk management. This is one of the most important parts about trading because no matter how good your strategy is, losses are going to happen. It's just part of the game. One thing that I like to do is think of it like this. Losses should be small enough to consider fees, or just think of them like business expenses. You want to manage your risk in a way that keeps you in the game so that you can stay profitable long term. That's what I'm about to teach you. So proper risk management separates traders from those who last to those who lose all their money. Now, risk can vary depending on what market you're trading. Different instruments have different contract sizes, shares, ticks, lots, and levels of volatility. So no matter what market you're in, the same risk principles apply. It is so important to know what you're willing to risk when you get into a trade. So for example, if your position is too big, it could wipe out an entire small account. But if you're trading properly with proper risk management and proper position size, the loss should feel like just a fee, and it will allow you to live to trade another day. It won't hurt your account much. Every time you take a trade, your stop loss should tell you exactly how much you're willing to risk. A common rule that most traders use is risking no more than 1 to 3% of your capital per trade. Would you lose more than 1 to 3% of your account? If the answer is yes, then you need to reduce your risk. This keeps your downside limited and gives you room to grow. When you combine a solid strategy with strong risk management, you're not just guessing anymore. You're trading with intention. And everything I'm about to show you next is built on this foundation. Let's talk about strategy. Having a strategy is one of the most important pieces of this process. A strategy gives you clear structure, it gives you entry criteria, exit criteria, and helps you stay emotionally regulated when you're in your trades. One of the biggest mistakes that I have seen in the entire trading industry is people who strategy hop. trying something new over and over and over again without giving it its due diligence, without trying to master the strategy. But the truth is, consistency comes from sticking to one thing long enough to get good at it. You're not going to believe this, but I have used the same core strategy for the last 10 years. I built my process around a simple approach that I fully trust. It's clean, it's repeatable, and it helps me find consistency in the markets. You don't need to overcomplicate things. Simplicity is what brings confidence. When you actually understand what you're doing and why you're doing it, you feel like you're in control and you're not just guessing. For me, that includes trend lines. I'm a trendline trader. I use them to find clean, high probability setups based on price action and structure. That's the foundation of how I trade. And part of that structure comes down to time frames. Some strategies work better on higher time frames, while others work better for lower time frames. A lot of traders, including myself, have different strategies depending on what the market is doing and different time frames that they're looking at. That's normal. So when I talk about strategy, I talk about having a complete plan. And this goes from spotting the setup, managing risk, knowing exactly when to get in and when to get out. In the next section, I'm going to walk you guys through one of the exact strategies that I've used in the markets to help me generate $500,000 in trading profits. Now, this isn't theory. This is something that I've used in real trades, real market conditions for over 10 years. It's simple, it's structured, and once you understand it, you'll be able to use it on any market in any time frame. If you've been looking for something solid that you can actually follow and build on, this is it. Let's dive in. So now that you've seen how the 3 touch point trendline break works, let's break it down step by step. So you've been able to identify how do you trade a 3 touch point trendline break, but now we need to see how do we find them. And that's by something called a top-down analysis. So let's get into the charts and let me show you how it works. So the concept of a top-down analysis is starting at a higher time frame, the top of the time frame, and then we continue to work our way down time frames. We're in the monthly time frame now, same as all the other past examples that we've gone over before. We're in the monthly time frame. We're going to draw our trend lines just like we have in the past examples. We're going to the toolbox over here. We're going to select the ray tool. We're going to draw a downward trend line. We're looking for the highest point that we see on the screen for a downward trend line. We're going to try to capture as many touch points as possible without having price intersect. Now, this is a new concept. Before, when we drew our trend lines, we just tried to capture as many touch points as possible. When doing our top-down analysis, we want to make sure that we also capture as many touch points as possible, but without having price poke through or intersect. So the reason that we don't want price to intersect is because we want to be able to utilize price action in real time. And this will start to make more sense as we continue this top-down analysis. But we've drawn our first downward trend line, nothing new. Let's continue to draw another trend line, which will be our upward trend line. Now for our upward trend line, we're looking for the lowest point that we see on the screen here. We're trying to do the same concept as before, capture as many touch points as possible, but without having the price intersect. So at one point, this would have been a great line. We've got touch point, touch point, touch point. The reason this line is not valid is because price is already broken through. We want to be able to utilize the price where it's at right now. I'm going to change the color of this trend line to help us differentiate the bullish from bearish trend lines, the upward from downward trend lines. And another easy way to remember this is when drawing your trend lines, doing this top-down analysis, think of the lines as though they're holding the price up or holding the price down. So if at any point price is breaking through, it's incorrect. So making sure that all touch points are captured without breaking through the lines. So a rule of thumb when coming in with steeper trend lines, always utilize the most recent touch point as your new point A for the new trend line. Think of it like your previous point B will be your new point A. So we're going back to the ray tool here. Previous point B, or most recent touch point here, will be our new point A. Same concept, trying to capture as many touch points as possible without having the price intersect. So this wouldn't work, this wouldn't work. This is the only area where we can draw our steeper upward trend line. So we have just done our first section of the top-down analysis in our monthly time frame. Once we've drawn as many trend lines as we can on the monthly time frame, and there's no other lines we can draw, that signifies that we can go from the monthly down to the weekly. So we're going to continue this top-down analysis. And something to note is that as you go down in time frame, we're getting more precise or looking at more information here. So some of your lines will be slightly off, so we just need to make some slight adjustments here to make sure they're a little bit more accurate. So we've just gone from the monthly time frame to the weekly time frame. There are going to be many instances where you go from one time frame to the next and there's not going to be much of a difference. There's not going to be any additional lines that we need to draw. So your indication to move down a time frame is always if you cannot draw any steeper trend lines, then you'll continue down a time frame. So there isn't any change between the monthly and the weekly, so that just signifies that we need to continue working our way down. So we're in the weekly time frame. Let's move down to the daily time frame. And feel free to utilize this plus or minus button to help you zoom out or zoom in of the price. So as we move from the weekly time frame to the daily time frame, our lines are a little bit off. We need to make sure that we slightly adjust these to make sure they're a little bit more accurate. And we're just going to continue moving down time frames. So if you're trading in the 5-minute time frame or the 1-hour time frame, you'll continue this top-down analysis. You'll do monthly, weekly, daily, 4-hour, 1-hour. If you're a lower time frame trader, you'll do monthly, weekly, daily, 4-hour, 1-hour, 30-minute, 15-minute, 5-minute, so on and so forth. So you'll just continue this process until you reach the time frame that you're trading in. So there's a steeper trend line that I can draw on the daily time frame. Previous point B, or most recent touch point, is going to be our new point A. Now for this line, we can't go very far. This is as far as we can go without having price intersect, but we need to draw lines like these so that we can continue to track price steeper and steeper. All right, we're in the daily time frame. Let's work our way down to the 4-hour time frame. Now this time frame is where I personally stay. This is the time frame that I trade in. So when I do my top-down analysis, I go from monthly, weekly, daily, and then I stop in the 4-hour. For anyone that's trading lower time frames, they'll continue this process and work their way down to their designated time frame. I'm going to slightly adjust my lines to make them a little bit more accurate, and then I can see some steeper trend lines that I can draw in the 4-hour time frame. I'm going to use my most recent touch point as my new point A. Try to capture as many touch points as possible without having price intersect. So on the 4-hour time frame, this is as many downward trend lines as I can draw. This is as far as I can go. But we can draw another upward trend line here. Go back to our toolbar, to the ray tool. Most recent touch point is going to be your new point A, or your starting point for the trend line. Try to capture as many touch points as possible without having price intersect. All right, there we go. This is as far as we can go in the 4-hour time frame. So now I've just shown you how to find a 3 touch point trend line. But now we need to wait for the break. Let's watch price and see if we can get a break of this downward 3 touch point trend line. Okay, we've just been presented with a break of this downward 3 touch point trend line. We know that this signifies an entry. Now, before we get into our trade here, before we take our entry, I want to introduce a new concept called the safety line. This concept is the exact reason why I've been able to stay consistently profitable in the markets. It helps me manage my risk, keep it low. It helps me capitalize on profits and tells me exactly when to close my trade. Now let me show you how to draw this safety line. So the concept of a steeper trend line is not new, but the way that we utilize this is. So we're going to go to the toolbar over here to the left. Previous point B, or most recent touch point, is going to be point A. Making sure you come in, capture as many touch points as possible without having the price intersect. But now the difference is this line is called our safety line. This line will keep our risk low. This will allow us to capitalize on profits and tell us exactly when to close this trade here. So now that we have drawn our safety line, we can enter our position here. We're going to hit the buy button to place our order. All right, we are now in our trade. Let's see how this trade plays out and see if it breaks our safety line. As you can see here, this price has moved aggressively in our favor, but we still haven't had a break of our safety line yet. All right, we have just made it to real-time price action. This is where the price is trading at right now. So the price hasn't broken our safety line yet. So you're able to see what this trade management looks like, when to get into your trade. Now let's go over some examples of when do we get out. So we know if price breaks our safety line, that's our indication to close our trade. So if the price comes down and breaks this safety line, this is our indication right here to close this trade. But let's go over a scenario if it doesn't. If the price comes down and actually respects our safety line, creating another touch point, and then continues to move in our favor, so this is our indication to stay in that trade. So only until the price breaks our safety line do we need to close this position out. Now let's go over another example. We're looking at crude oil on the 4-hour time frame. Now in this scenario, I've already done my top-down analysis. As you can see here, I was able to spot a 1, 2, 3 touch point trend line. What we're missing is the break. So let's continue to wait and see if we can get a break of this trend line. Okay, we were just presented with a break of this upward 3 touch point trend line. Now remember, before we get into this position, we need to draw something called the safety line here. Let's go back to the ray tool over here. Same concept when we're drawing our steeper trend lines. Most recent touch point or previous point B is new point A. And then we're going to try to capture as many touch points as possible without having price intersect. Now that we've drawn our safety line, it's time to enter our position. Now let's see how this trade plays out and if it breaks our safety line. All right, as you can see here, we are in profit and price has still not broken our safety line yet. So we continue to stay in this trade until price does. All right, we have finally been presented with a break of our safety line. It's time to close our trade and take our profits. Close position here. So you can see, we entered the price over here when we got the break of our 3 touch point trend line. We drew our safety line. We stayed in the trade until we got yet another break. Price broke our safety line, which indicated an exit. So we've got a very clear entry and a very clear exit. So there you have it. We've just gone over 2 examples of the 3 touch point trend line break. Now let's talk about some other important factors that you need to know about trading. Now that you've seen how the 3 touchpoint trendline break strategy works, it's time to test it for yourself. That's where backtesting and forward testing comes in. Backtesting is essentially going back in time, just like we did in our second trade example, to see how the strategy performs on past data. And it allows you to see how many of your setups would have worked out. When you're learning a new strategy, backtesting is one of the most important things that you can do. It gives you a chance to see how often these setups perform under different market conditions. Remember earlier in this video, we analyzed trending markets, bullish, bearish, and consolidation. Backtesting allows you to see how those setups perform in those different market conditions. It also helps you build confidence and understand what clean setups actually look like. Now let's talk about forward testing. Forward testing is watching how your strategy performs in real time, similar to the first example that we went over. And this is usually done on a demo account where there's no risk involved. Later in the video, I'm going to show you an incredible platform that allows you to backtest as well. But let's move on. Let's talk about brokers, what they are, what they do, and why you need them to trade. So simply put, a broker is the middleman between you and the markets. They provide you with a trading platform and give you access to markets like futures, forex, stocks, and crypto. And they handle the execution of your trades. Without a broker, you can't place trades. They're the ones actually connecting your buy or sell orders to a larger exchange or network. Another thing that your broker does is allow you access to leverage. Leverage means that you can control larger positions with smaller amounts of money. For example, 10-to-1 leverage means that you only need $1,000 to trade a $10,000 position size. But with leverage comes something called margin. Margin is the amount of money that you need in your account to hold a position. It's basically your collateral. If the market moves too much against you and you don't have enough capital in your account, the brokerage can close your position for you. That's called a margin call. You don't want that. So while leverage can help you grow faster, it can also increase your risk. That's why it is always important to have proper risk management in place, which is something we've already covered earlier. Understanding how brokers work is a key piece of the puzzle if you're serious about trading. Now, I use a broker called TradeStation. It is a regulated broker in the US that offers equities or stocks and futures, which is what I trade. If you're interested in joining TradeStation as well, the link will be in the description below. So now that you know how brokers work and what actually goes on behind the scenes, it's time to actually place trades without risking any real money. This is one of the most important phases when learning any strategy. It's where you take everything that we've gone over and put it into action in a risk-free environment. So now let's talk about demo trading. Demo trading is where you can trade the live markets, but using simulated capital. So you're still seeing real market movements in real time. The only thing that isn't real is the money, which means you can practice without the risk. This is one of the most valuable tools when learning a new strategy, like you are now. It lets you build confidence, test your execution, and get used to how your trading platform works, all while making mistakes that won't cost you anything. You'll start to get a feel for how the market moves, timing, and your own decision-making process. And a side note here, when setting up your demo account, use the amount of money you would actually invest in a live account. You don't want to set your account to millions of dollars and start investing in huge positions that you wouldn't actually be trading. Treat this like it's your real capital. That way, when you actually make the transition to live trading, your habits and expectations will be in check. Now, once you start placing trades, whether that's live or demo, there is one thing that's going to make a massive difference in your trading, and that's journaling. Journaling is where you track your trades, your decision-making, and your feelings throughout the entire trading process. So this isn't just about recording wins or losses. It's not focusing on the dollar amount. It's working on the process. It's about becoming more self-aware and intentional about your trading. For me, journaling was a huge pivot point in my trading career. It allowed me to visually see what I was doing right, what I was doing wrong, and double down on the things that were working and to stop making the same mistakes over and over again. And I use TradeZella for all of this. Let me pull it up and walk you through some of the most powerful tools within this program. So here is the TradeZella platform. This visually shows me what I'm doing right, what I'm doing wrong, and allows me to track all of my stats here. I can see my win percentage, my average win to loss, my profit factor, and then I can even go into each individual trade and see what went right and what went wrong. Another tool you can use is the playbook feature here. This allows you to test different strategies, like the one we've gone over here, the 3 touchpoint trendline break. Test it, see if it works. We've got something called a trendline bounce, a break and retest, a 2 touchpoint trendline break. This is also a place where you can do backtesting like what we went over earlier. If you're interested in using TradeZella as a journaling tool, use code Tori10 for 10% off of the monthly subscription or Tori20 for 20% off of the yearly subscription. All right, once you've been journaling, testing, and building real confidence in your strategy, the next step is what everyone looks forward to, going live. This has been the moment that everything has been leading to. You've learned the strategy, you've backtested, you've forward tested on demo, you've journaled, you've put in the work. But before you enter your first trade, there are a few things that you need to understand. You only go live when you have the data to back up your decision. You need to know that your strategy works, and you need to have the confidence knowing that you have the ability to execute it. So what does that mean to have the data to back up your decision? Something like journaling allows you to track your performance and see hard numbers to show you profitability and consistency. And that confidence comes from preparation, not guesswork. Second, you need to trade with money that you can afford to lose. I cannot stress this enough. If you are trading your rent money or your savings, you are not trading, you are actually gambling. That kind of pressure will wreck your decision making. So start small, grow slow. The markets are not going to go anywhere. There are always opportunities. Next, know that going live is very different from trading demo. Your emotions hit 10 times harder when you're going live versus demo. That's why demo trades feel like they are perfectly executed, then fall apart when going live. So expect that shift and give yourself time to adjust. It's all part of the process. Fourth, don't rely on trading as your only source of income from the start. Having another source of income allows breathing room and helps you avoid forcing trades just trying to make money. You want to be able to enter your positions with clarity, not desperation. And finally, and most importantly, do not rush this process. Sustainable trading takes time. Every profitable trader that you look up to has gone through months, if not years, of learning and refining before everything clicked, including myself. Let this be something that you build for life, not a quick hit. Now it's on you. Put this into practice, stay disciplined, and remember, trading does not need to be complicated. If you show up every single day with consistency and follow what we've gone over in this masterclass, you can see success in trading. Now you have everything you need to get started. If you're looking for a more advanced approach and learn directly from me, a trader who has been able to generate over $500,000 in trading in the markets, all the information is in the first link in the description below. Thanks for watching, and if you want to see more content like this, don't forget to subscribe to my channel, hit the like button, and drop a comment below.